IAS 36, impairment of assets, right? So guys, what is this topic, impairment of assets? Impairment of assets actually identifies some procedures to ensure that our assets are not carried at a value which is higher than the recoverable value of that asset. If you have an asset and if you are showing that asset for $50 million, when you can receive only a benefit of $5 million from that asset, then technically your financial statement is overstated. Asset value is overstated. And IAS 36 exists to prevent this kind of situation. So that will be the main objective of IAS 36. Think about it, you have purchased a new house maybe, and you have spent $1 million on that particular house. It's a beautiful house, yeah? Yes, you have depreciated it over like 1 year, 2 years, it's still new. And your carrying value is still $1 million. But all of a sudden, something bad may happen with your house. What kind of bad thing? It can be flooded, there can be fire damage, there can be earthquake and other type of problem. And now, the value of that house is no longer $1 million anymore. You cannot recover $1 million value from that asset, neither by selling it, nor by using it, nor by staying in it. So the value of that asset must be reduced down significantly, right? That was the big value, take it out and throw it away. Reduce the value significantly. And that exercise is impairment test or impairment accounting for impairment. So guys, here you go. We will talk about the objectives of IAS 36. The objective of IAS 36 is to provide some procedures to ensure that none of your assets are carried at a value which is higher than the recoverable value. You have that asset which is damaged and destroyed. That asset's recoverable amount has fallen drastically, and maybe the carrying value is still showing the higher value. Write it down, guys. That is the objective, right? Now here we are talking about recoverable amount of an asset. What is the recoverable amount of an asset? We can recover value from an asset in multiple ways. Number one way is to sell it. In that case, you will recover NRV. And number two, use it. In that case, you will recover some value, and we call that value in use. So how do we recover? These are the main two ways, yeah? Sell it, use it. Sell it, NRV, use it. We call it value in use. Value in use is essentially a present value of future inflow of economic benefit, net inflow, right? That's value in use. Make sure that you have understood the basic principle of this IFRS. Well, now by selling, how much value we can recover? What is the measurement of that? By selling, if you sell that asset, then what's gonna be the measurement of recoverable amount? Sales. NRV, yes?
So fair value. Yeah.
NRV, right?
Fair value.
Less cost to sales, yes?
Yeah.
Right, good. That's a good understanding. Now, I'm going to ask you another question. Is this NRV, the recoverable amount, is the same as the residual value, IAS 16 or IAS 38 or not? What's your understanding of it? Residual value, we have learned that is NRV. And here, under recoverable amount, we are talking about two things. And one of those things is NRV of that asset. Right? So my question is, whether this NRV is equal to or not residual value of asset. What's your understanding? Is it equal to residual value? We are talking about the same thing, right?
Yes, sir.
Well, anyone else? Any other understanding? What about Ratin? Hey, Ratin, can you give us some insight in it? Mubarak, yeah. Try, please. I appreciate it.
No, sir, it will not be equal.
All right. What is the difference?
Residual
Yes.
ভ্যালুটা আসলে মানে ফিউচারে আমরা বিক্রি করব, মানে এটা সার্টেন টাইম পরে আমরা বিক্রি করব তখন। আর এখানকার এনআরভিটা বলছে যে আজকের দিনে সেল করতে গেলে সেলিং প্রাইস এবং অন্যান্য কি খরচ হবে, মানে আদার খরচ, সেল করতে গিয়ে কি খরচ হবে। ডিফারেন্স হচ্ছে টাইমিং ডিফারেন্স আর কি।
All right, Mubarak Hussain gave me an answer. Let me put that answer on the board and then I will clarify. So let me better
May I tell?
back. Yes. Masood bhaiya.
রেসিডুয়াল ভ্যালুটা হচ্ছে স্যার আমার অ্যাসেটে ইউজফুল লাইফ যদি 5 ইয়ার্স থাকে, 5 ইয়ার্স ইউজ করার পর যে ভ্যালুটা আমি পাবো মার্কেটে সেটা হচ্ছে রেসিডুয়াল ভ্যালু। আর এনআরভিটা হচ্ছে আমি কারেন্টলি যেই অবস্থাতে আছে অ্যাসেটটা, আইদার হয়তো বা 2 ইয়ার্স আমি ইউজ করেছি, দেন এখন যে সেল করতে যাচ্ছি এই যে ভ্যালুটা।
Okay.
সো মেইন লাইক হচ্ছে আমি ফুল ভ্যালু ইউজ করে ফেলেছি, আর এটা হচ্ছে করি নাই।
Right. Very good. Those are very good understanding. Now I will just put some additional points over here. So Hasif and Mubarak gave me very good answer. Masood Bhuiya said that both are equal. Actually, those are not equal. So Hasif and Mubarak Hussain, you guys are right. Partially right at least. So NRV, Mubarak Hussain said, if I sell the asset in the future, then how much NRV we are going to receive? That is residual value. Sell the asset in the future when the life is over. Actually, this answer is incorrect. This residual value is today's selling NRV, right? Is the measurement of NRV today. So sell the asset today. Today means on the measurement date, not exactly today, like right now. And this NRV is also same measurement, sell the asset right now on the measurement date. So what's the difference? Sell it at current condition, then how much you can get, that is the normal NRV, and this is a different NRV if you sell it at end of useful life condition. Condition needs to be different. End of useful life condition. That's the difference between residual value and this kind of NRV, normal NRV, guys. The timing difference is not there. Hasif said there is a timing difference. It's not because of timing difference. We are considering the condition difference. At the current condition, at assumed a condition that the asset will have at the end of useful life. But we are taking today's prices from the market, right? We are not assuming, what will be the price after 15 years in the market? No. What's the current price in the market for old scrap asset? Residual value, that is. Hopefully you got that. Very important, these kind of little bit things. Let's move on to our next topic. That was the limitation of this particular IAS, or limitation of a scope, not limitation in general. Limitation of a scope means for what kind of items this IAS will not be applied. Number one, IAS to inventory. Yes. And number 2, contract asset IFRS 15 that comes from a contract with a customer. Then number 3, deferred tax asset that is under IAS 12. Then we have employee benefit asset IAS 19, financial assets, those are like investment in normal bonds, investment in shares, etc. under IFRS 9. However, this is actually partially excluded. I have said investment in share is excluded. Fine, but that is only partially true. Investment in share can be investment in associate, subsidiary, joint venture. Those are not excluded. Those are still part of this IAS. So investment in associate is good under the scope. Investment in subsidiary under the scope of this IAS, and investment in joint venture is under the scope of this IAS. Investment in normal type of share like 5%, 2% excluded. Investment of bond excluded from the scope of this IAS. Fine. Then investment properties IAS 40, then biological assets IAS 41. However, for biological asset also we have exclusion. So we are taking biological assets that are measured at fair value less cost to sell. In that case we are excluding those, otherwise we are not excluding those. So remember that not all biological assets. Similarly, if we talk about investment property, some of the investment properties are measured following the cost model of IAS 16. Those investment properties will still be subject to impairment testing IAS 36. Some biological assets are measured similar to IAS 16, and those biological assets will still be subject to IAS 36 impairment testing. Remember that. Insurance contract IFRS 17 excluded. Non-current asset held for sale IFRS 5. Right, we do not need a separate IAS 36 impairment test on it. IFRS 5 provides you some sort of mechanism to reduce the asset's value once the value has fallen. So we just follow that, and that is sufficient. Good. Alright then, we will talk about a particular issue at this moment, which is the issue of revalued asset. So what's the deal with revalued asset, guys? Well, say you have revalued an asset at the fair value. This is the fair value, yes? Maybe that is $10 million for a building, What's the fair value? Essentially the selling price. Now the question is, what is NRV? NRV equals to that fair value, selling price, less selling cost. Fair value less selling cost. So NRV should be, in this case, lower than the fair value. Like 10 million, that's the selling price. Then deduct some selling cost, maybe 0.1, $9.9 million. When you revalue that asset, the balance sheet value is 10. Recoverable amount is 9.9. Is this asset impaired? That's the big question. Confusion can arise. You have a logical point that asset should be brought down to 9.9 because NRV, recoverable amount. Yeah, asset is showing at higher value than the recoverable. That's your logical argument. But IAS 36, basically we are not that strict. You need to understand that, yes? We are not that strict. So IAS 36 will just overlook this issue, right? Gives you permission to revalue that asset, and you are not required to do impairment test immediately. So it is a normal assumption that a revalued asset is not impaired immediately when the selling cost is insignificant, and normally it is assumed that selling cost will be insignificant. However, but if you have indication that there will be substantial selling cost for this asset, then considering the materiality, carry out impairment test and write down value of that asset to the recoverable amount in that case. Let's talk about review of indications. Every single year, every single reporting period, you need to check whether your assets have any indication, bad indication of impairment or not. Well, you are depreciating that asset properly. I appreciate that. Still, you need to check the condition of that asset. Not only the physical condition, internal condition of that asset, but also external environmental conditions regarding that asset. And that is review of indication of impairment loss. Every single reporting period, you need to do that for your asset. Well, so what are those indications? What you need to check? We have a list and we have divided our indications in internal portion and also external portion. Let's talk about internal indication. Go to the asset and check whether the asset is physically damaged or not. Like if there is an accident, obviously, yeah, physical damage, impaired, yeah. Then check the expiry date or such kind of things like obsolescence to find out obsolescence. There can be technological obsolescence also. There can be out of fashion type of obsolescence. Be careful about those kind of obsolescence. Like if you're talking about fashion items or mobile phones, they can have technological obsolescence. It still can be sold, but maybe at a reduced price. Clothing will not have technological obsolescence. They will have out of fashion type of obsolescence, yes. Then adverse change in assets' economic performance. What that may mean? It may mean that your asset is producing less, it is running for less hours and it is becoming hot, and then you need to give it some rest. The asset is producing wastage, faulty products, it's breaking down now and then. These are adverse change in assets economic performance. And then another internal indication is the asset is underutilized. Well, the asset is underutilized means the value in use, the present value that you receive from using that asset is going to be lower, right? So recoverable amount may also be lower, and in that case it can be potentially impaired asset. So set aside those internal indications. Let's focus on the external indications. Number one, fall in the market value of that asset. You have inventories of iPhones, or let's say for example Samsung phones, right? Flagship phones. All right, then initially when it is launched for the first time, the price is so high like that, right? And your cost also was very high. But later, value has fallen. So if it is inventory, then you don't care about it because inventory IAS 2 and IAS 36 will not be applied. But if it for the use of your employees in the company, you provide mobile phone to your employees, right? Those are company's assets, or laptop. Then you need to carry out impairment tests. Those will become PPE for your organization. Mobile phone for reselling, those are inventory, and inventory is not within the scope of IAS 36. Significant adverse change in the environment in which the entity operates or in which the asset is utilized. Say about a technological change adverse, say about a political change Yeah, political unrest maybe in USA. What is happening? Like those guys are becoming crazy. Yes, Black Lives Matters. That movement is going on. We support it. However, there is also a lot of unrest, burning, damaging. So that kind of political unrest is going on over there in USA. That can adversely affect your business, and NRV say that, or value in use say that, of your asset can fall because you are unable to use your asset properly in this environment. Fine. Then increase in interest rate in the market, and that will have some negative impact on your assets value in use. Well, your discount rate of cash flow indirectly depends on the interest rate, right? Interest rate is not the direct discount rate. Sometimes it can be the discount rate, sometimes. But normally we look for better discount rate in IAS 36. Better discount rate. But that indirectly depends on interest rate. So high interest rate may mean high discount rate and low present value of future economic benefit, essentially the value in use, and your asset may be impaired. Now the final one over here is the asset's carrying value is lower, market capitalization rather is lower than the carrying value of net asset for a subsidiary, talk about that, or for associate, joint venture, etc. We are talking about those kind of investees. Subsidiary, associate, JV, that is joint venture. Yes. What is market capitalization? Market share price is like $70 million, but book value of equity $170 million. So book value is higher, market value is lower. That's a problematic situation. Investigate. Now, excessive dividend payment. Talk about only subsidiary, associate, joint venture. Normal shareholding outside of the scope of this IAS. Remember that. So talking about those, if those subsidiaries, joint ventures or associate pay excessive dividend in a particular year, which may be higher than the profit for the year, that may indicate maybe the subsidiary, associate or JV is impaired. Maybe it is closing down, right? Just a possibility, not sure. You need to investigate, right? It's not confirming that it is obviously impaired. No, just a possibility, indication, right? Carry out investigation, do the impairment test and look for the genuinity of your assumption. Fine. And cash out, cash credited, like cash is drained out of the company because of the dividend payment. Because of that, as a company's share price may fall as a result of that significant dividend payment. Other indications, guys, cost of acquiring an asset is significantly higher than what you have planned for initially. You want to buy an asset, a machine, and it was your budgeted cost $20 million, but actual cost became $50 million. Then you need to think, did I pay overprice? Is it the real value? Is it the normal value, like $50 million? Is it? Or I have purchased mistakenly or wrongly. My company, my manager purchased it at a high price and the asset should be written down at a lower price. Because I have budgeted only like $20-30 million, but they have paid $50 million. What's the reason? Let's investigate, yeah? So cost of purchasing, the cost of operating sometimes can be higher, significantly higher than the budgeted cost. In that case, That's a negative economic performance, and impairment test is necessary in that case. On the other hand, income can be lower than the budgeted income. Income can be lower than the budgeted income. You have initially expected that if you put some cars in Uber, like you will buy 20 cars and put those in Uber, then those will become your PPE, yeah, business use. Sorry. All right, you estimated that per month you will be able to earn 30,000 per car, but later you find that no, it's not 30,000. Maybe it's 15,000 net that you save, that you actually get. So poor economic performance, indication of impairment. And then budgeted cost or income significantly increased because of some reason. Income decreased, cost increased. Income decreased, cost increased in the budget for the next year, maybe. Yes, initially your level of income you put in the budget was 30,000 per month. Now for some reason you are saying no, it's not gonna happen. For the next year, let's put not 30,000, 20,000. That's our budget. That's our target. Yeah. Give that target to manager. Yes, Uber manager, your Uber manager. Yep. I want 20,000 income per car next year. So you have curtailed the budget or target. Of course, your income is going to fall. Value in use is going to fall. Expected value in use is fallen. So guys, indication of impairment, do that all right. Expecting operating loss from your business or from your asset, cash generating unit, or you are expecting cash outflow, yeah, negative cash flow. Those are indications of impairment loss. So we got that indication. Indication means possibly that asset is impaired. Then let's go for impairment test. When to carry out impairment test? Number one thing to understand, there is indication means do the test. No excuse, no nothing. There is indication, do the test, right? If the asset is within the scope of IAS 36, do the test. And some of the assets will require, apart from the indication based impairment test, annual impairment test, additional annual impairment test. Those are like indefinite life assets like goodwill and other indefinite life intangible assets. So this impairment test actually is the main review, main calculation and everything, whether the asset is genuinely impaired or not. Yes, after the indication you do it, and sometimes without indication you need to do impairment test annually for some sort of asset. Once again, those are indefinite life intangibles including goodwill. So here you go guys, if you are testing PP, impairment test is necessary if there is an indication for all assets, basically not only PP. Indication means do impairment test for all the assets that are within the scope of this IAS. Finite life intangible asset, look for an indication. Indefinite life intangible asset, every single year there is indication or not, doesn't matter. And additionally, if there is indication, do another test in the same year. Sometimes in a single year you may need to do more than one impairment test, 2 times, 3 times, 4 times. You got 4 times indications in January, in March again, in May again, in September again, 4 times indications. Carry out 4 tests. That's the requirement of IAS 36. Yes. Goodwill impairment test every single year. And also if there is indication, do that again. It's like that. Alright guys, next, if you are doing annual impairment test for goodwill, or indefinite life intangible assets, do that annual test at the same time every year. Last year you have done it in March. This year again do it in the March, like that. And apart from that, additional impairment test may be required if you got indication. Then additional impairment test will be necessary. All right, then you got the indications and you now know when to carry out impairment test. Let's put it in rest for a little and let me ask a question to Bakibilla. Tell me a few of the indications that may trigger impairment test.
Sir, if it is physically damaged,
Right.
then if there is an internal indication that the product is not going to perform as it is supposed to be, if they get an indication,
That is poor economic performance, right? How do you know that the asset has poor economic performance? What could be like symptoms of poor economic performance?
capacity might reduce.
Okay.
There might require a lot of repairing from time
Okay.
to time.
Very good. Very
Might
good.
indicate that this is not overhauling. It could be overhauling. Maybe the parts need to be replaced very often.
Okay. Okay.
These are some indications which I
Okay.
think.
Right. Initially, you have estimated that you need to overhaul the asset after 3 years, yeah? And later you are finding no, it's not surviving for 3 years. 2 years gone, and it already required overhauling. This kind of problem may happen.
Yeah.
Well, Masood Bhuiya, can you give me some additional indications that you may look for? Masood Bhuiya. Masood Bhuiya. Tanvir Asif, you have microphone.
Sir,
Oh, Masood Bhuiya, yes, you are.
Hello.
Yeah. Yes.
yeah, sir, fall in market below, and another is adverse effect from government side that you said
Very good.
significant.
Very good. That is adverse change in the environment in which the asset is operated or business is operated. Environment, say it political, legal, technological environment. Yes, you are right. Government, it's part of environment. Government policy change can significantly affect economy, political situation, etc. Yeah, go on. Give me some other indications.
Increase in finance cost.
Thank you
interest
very
rate.
much. Yes. Next. Any other?
No, sir.
Okay, fine. Tanvir Asif, can you give me some indications based on budget type of thing, budget forecast, like that? Budget, actual budget is changing for the asset. Yeah. Tanvir Asif. No?
Reduction in economic benefits.
In the budget?
Yeah,
But-
like you budgeted that you're gonna get say 10 grand for the whole year, but you're only getting 8 grand. So that
Wow.
indicates that.
Income.
Yep. Income, like benefits that's being generated by the asset. So that
Good.
indicates that your initial estimates of how you revalued the asset is not going according to plan. So that means a reduction in the performance of the asset. So that means that it needs to be impaired.
Awesome. Any-
Other examples could be political unrests,
Yes, we have covered.
where the operating environment of the asset has significantly changed.
Right.
Idle assets sitting idle.
Very good. Very
What
good.
else? Yep. That's,
Nice.
I
That
think
will do.
everything else is covered.
that will do for now. Not everything is covered. We have a few more points, but that will do for now. That was a good brainstorming for now. Then let's move on to our next topic. When the asset is impaired. The asset is impaired when the recoverable amount is lower than the carrying amount. You are showing that asset for 50. You can recover only 30. That asset is impaired. Yes. Very easy thing to do, and the impairment loss will be the difference between recoverable amount and carrying value. The asset should be written down to the recoverable amount. And the recoverable amount is the highest value that the entity reasonably expects to recover, either by selling that asset or by using that asset. We talk about highest. If you have different measurements, then take the highest value, means the higher of value in use and NRV. All right, now NRV. Talking about NRV, what NRV we should take? NRV is the selling price less the selling cost. Now, what is the selling price in that NRV? If you already have a binding selling contract with someone, which is highly unlikely, I will tell you why it is highly unlikely in this case, in the context of IAS 36. If you have a binding sales contract, then what's the price in that contract? That is the first priority. Yep, binding sales agreement contract. If you don't have that, then go to market and take a market price for the current condition of that asset. Current condition. If you don't have active market for that asset, then determine fair value in other ways, right? Go to IFRS 13 in that case, I would say. IFRS 13. And IFRS 13, actually, this is not IFRS 3, this is IFRS. IFRS 13 actually provides different techniques of measuring fair value in absence of market price. Now come back to this. We are saying which is highly unlikely. Why it is highly unlikely? It is highly unlikely because if you have a binding sales agreement, then you need to first judge whether this asset falls under IFRS 5. That talks about non-current asset held for sale. And discontinued operation, that kind of stuff. Whether that asset already falls under that IFRS or not. If it falls under that IFRS, then IAS 36 will no longer be applied. Check whether asset falls under IFRS 5 or IAS 36. Most probably it will go under IFRS 5. But for IFRS 5 there are other conditions, not only the binding contract. Binding contract is not a condition, but sales needs to be highly likely. Binding contract means sales is definitely highly likely. Now we are talking about two terms again and again. NRV, value in use. What's this value in use guy is? It's essentially a present value of future net inflow of economic benefits that you expect to receive from that asset over the useful life if you use that asset. That is value in use. In short, present value of future net inflow of economic benefit. When we talk about future net inflow of economic benefit, it all on a sudden becomes complicated. Future means we do not have any factual data. We need to estimate what income you are going to receive. We need to budget. We need to focus. And it may go wrong, and the scope of manipulation is there. We need to come up with a discount rate. We need to find out the income, also expense that makes up the net figure, right? Net income we are talking about. We need to estimate the life, how many years we are going to use it. After 5 years, what will be the income? After 6 years, what will be the income? Very difficult to budget. See that future, right? Maybe next year you can predict, but after 5 years, 6 years, it's difficult. So value in use can be complicated, guys. Now, regarding cash flow, I have some principles regarding the cash flow in IAS 36. So what cash flow should you use? The general principle is that the future cash flows should be reasonable and supportable by assumptions, right? Solid assumptions. These assumptions should be based on your historical pattern, existing contracts with customers, etc. Now, once you have made that budget or forecast, future 5 years say, 1 year has gone. When the first year has passed out of your budget, now you have some factual data. All those data are estimated. Now for the first year you have budget, those are estimates, and also factual result. At that point you must carry out a variance analysis, compare your budget with the actual result. I have budgeted 20 million income from first year. Did I receive 20 million? Is it adverse variance or favorable variance? Based on that, we will adjust future cash flows. Another 3-4 years out there, those cash flows will be adjusted based on the variance analysis. This exercise is very important, right? Suggested by IAS 36. Very important, because we already put our disclaimer, future we don't know. These are just estimations, right? And there is more possibility that estimations are wrong than it can be correct. What about the discount rate? Once again, the discount rate should appropriately reflect the current market assessment of time value of money. What does it mean? Means possibly take the rate from the market interest rate, market discount rate. Then the second part says it should reflect the risk specific to the asset or cash generating unit. Means, yes, we are taking the market rate, but that may not essentially a borrowing rate. It should be specific to that asset. It can be a leasing rate. If this kind of asset is leased, then what is the lease interest rate? In the market. So lease interest rate, we are taking market rate. Number 2, the rate is also specific to this type of asset. So better, yeah? So what we need to be careful about. This is the rate of return that an investor would expect or require if he needs to invest in an asset with similar characteristics. Nature of the asset should be considered. Timing of the cash flow should be considered. Risk of the asset should be considered. And amount of cash flow should be considered. After considering those things, what percentage of return an investor may demand? Use that return for discounting. Leasing rate, I like that, right? But it doesn't say that take leasing rate. IAS 36 doesn't say that. It's your own decision at the end of the day. Now, we need more guidelines on this item, value in use, because it's complicated. It's still complicated. So we have a guideline in IAS 36 for cash flow. If you make budget, take budgeted cash flow for next 5 years, up to 5 years, yeah? Do not take budgeted cash flow for 10 years, 20 years. Because IAS 36 assumes it's very difficult for a company or person to make forecast or budget over very long period of time, like 10 years, something like that. So 5 years, that's a reasonable period. Maybe your estimation over the next 5 years will be somewhat reasonable. Beyond that, reasonability of your estimation is highly questioned. So if your asset has useful life of 20 years, you are taking budgeted cash flow for 5 years. What about the next 15 years? So IAS 36 says, well, extrapolate the cash flow beyond 5 years. This is your budget that considers 1, 2, 3, 4, 5 years, huh? Say 10, 15, 20, 18, then 19 maybe, 1, 2, 3, 4, 5. I put 5 already over there. Now, the asset is gonna last long. Yeah, not 5 years. The asset is gonna last 20 years maybe. Extrapolate based on these. No, you do not need cost revenue breakdown anymore. The net cash flow is extrapolated, and this 5 years cost revenue breakdown you need to put in the budget, and the next net amount should be calculated. Extrapolate. In this extrapolation, you should assume reasonable and supportable growth rate. And normally this growth rate should be a declining growth rate, maybe like minus 0.5% per annum. Cash flow will reduce, but sometimes you can use positive growth rate also, but that should be low, right? These are just principles. But if you can justify like 20% growth rate, I have evidence to support that. Okay, you put evidence. I'm the auditor, I have nothing to say. I'll shut off my mouth at that point. But if you don't have evidence, go for the principle. Take a declining rate, reducing rate, yeah, minus 1% like that, or sometimes positive rate. Come up with some excuses, reasonable supportable assumptions for positive growth rate, but that rate, positive growth rate, should be low, not like 20%, unless you can support it. Hopefully that makes sense. Then in cash flow calculation, we need to take the net cash flow. That means income less expense. Income less expense. So the maintenance cost, operating cost, etc., fuel cost, etc., should be deducted. Normal repair cost should be deducted to calculate the net cash flow. Normal repair, yeah? Cash flow should be pre-tax. Not only that, the discount rate also should be pre-taxed. Discount rate also should be pre-tax. Pre-tax. This is your guideline. Now, next point is very important. You are making a projection over next 5 years, and you expect to make a big capital expenditure after 3 years. You can't take that capital expenditure. So future capital expenditure? No. Then increase in revenue because of future capital expenditure? No. After 2 years, I will construct another 3 floors of my building. So my rent income will be much higher. Let's take that in our consideration. No. Currently you have 2 floors. Your whole value in use calculation should be based on 2 floors for the next 20 years. Though you are going to have 5 floors after just 2 years time. No. Future improvement and future capital expenditures are outside of your consideration when you are calculating value in use. Be careful, yeah, very careful. So on the other hand, discount rate, once again, pre-tax discount rate, we are going to use asset specific market rate, current market assessment of time value of money, reflecting the risk associated with the asset. Market rate and risk is specific to the asset. For some reason, if you can't find that out, then use a risk-free rate and adjust that using the risk of the asset. If you can do that, like CAPM type of shit, like that you have learned in F9, something like that, do some kind of that crazy calculation. And if you can't do that, then use other rates. Yes, but you need to have genuine excuses, like I don't have market rate, so I'm using this kind of rate. Yeah, what kind of other rate? WACC, go for that. Incremental borrowing rate. Do not take a borrowing rate like for your loan that you have taken like 20 years back. Those are obsolete thing. Incremental means if you take a loan today, then what will be the rate of that loan interest? Incremental borrowing rate. Okay, take that and discount your cash flow using it. All right, now we will talk about some other issues here. Currency issues or country issue. You're from like New Zealand. Asif is from New Zealand, and Asif has an asset in Bangladesh. So there is this asset. What to do with that asset, Asif? The cash flow prediction of your asset needs to be made in BDT, not in New Zealand dollar. Yep. So make BDT cash flow projection. And when you make that cash flow projection, you need to consider the environment of BDT, situation of BDT in which the asset operates. Political situation, economic situation, technological situation of Bangladesh, not that of New Zealand. Right, the same asset may perform differently in New Zealand and in BDT, Bangladesh. The asset is placed in BDT. Consider the context of BDT to make the prediction of cash flow. So if your accountant is in the head office New Zealand, you need some sort of consultant here in Bangladesh, or maybe here in Bangladesh you have some other accountants. Those accountants should prepare this cash flow, not your New Zealand accountant. If New Zealand accountant prepares these cash flows, they will have different type of mindset. They will think about the situation going on in New Zealand, so their prediction can be significantly deviated from the real situation that is going on here in Bangladesh. Yeah, so consider the situation in Bangladesh, consider the currency of Bangladesh, and your projection of cash flow will be in BDT, and then discount that. The present value will be in BDT. Discount, and when you discount, and if you need to take a borrowing rate, do you take a borrowing rate from New Zealand company? We have 10%, 2% rate, or Bangladesh, we have 10% rate, 10%, but Bangladesh rate, of course, yeah. So use that. You have then the present value in BDT. Finally, then translate that in New Zealand dollar using a spot exchange rate. Means the measurement date exchange rate. Remember that. Very important, yes? All right. Hope you understand that. Next topic. Where to present the impairment loss. Once you have got some impairment loss, yeah, let's put an asset here. We were talking about a building. We purchased that building for $5 million. No, not purchased, carrying value, say. Recoverable amount, recoverable, 2 million. So loss, 3 million. Once we have figured out that loss, then we need to check whether this asset is revalued asset or not. If that asset is revalued asset, then we will put this loss in the revaluation reserve through OCI. Where did I go? we will put the loss in the revaluation reserve through other comprehensive income. All right, let's put revaluation reserve of that asset is $1.8 million. Not general revaluation reserve, be careful, of that asset, this building. So impairment loss of $1.8 million will go over there. This goes through other comprehensive income section of your statement of financial performance, and we have still $1.2 million loss to charge. $1.2 million that will go to retained earning. Impairment that goes to retained earning through POL, and this goes to revaluation reserve. Hope that makes sense to you guys. If it doesn't make sense, tell me. This is I believe this is easy. You have done it in like F7 or those kind of papers, so shouldn't be a big deal. Now if the asset has like zero revaluation reserve, then all the loss goes to POL, of course. Now we will talk about cash generating unit. What is a cash generating unit, guys? It is a group of assets that generate cash or revenue for an entity. Well, example of cash generating unit can be a subsidiary. Subsidiary is within the scope of IAS 36, but normal investment in share is not. It can be an associate, it can be a joint venture, or sometimes it can be a division, geographical division, Unilever Bangladesh or Unilever Chittagong branch, right? Like that branch division, etc. It can be a branch of a bank. Yeah, branch of a bank generates cash. Yep, carries out expenses, so cash generating unit. It can be a sales outlet if you have Mina Bazar type of like Tesco, that kind of type of business. Yeah, Walmart type of business. Yep, one outlet can be considered a cash generating unit, CGU in short. Well, what are the further implications for cash generating unit? Sometimes a cash generating unit may have some goodwill, or maybe not. Yeah. So when we are assessing the carrying value of the cash generating unit, this carrying value should be including the goodwill or allocated goodwill. The carrying value also should be including allocated corporate assets. So if we talk about a subsidiary, you need to inspect that. If it is a subsidiary, then carrying value of that subsidiary will be net asset plus goodwill. If it is a branch of a subsidiary or a division of a subsidiary, there goes subsidiary. And CGU is a division. This has many other divisions, big and small. Then subsidiary had the goodwill, not the division, $30 million. And we are doing, this is our target CGU. We are doing impairment test of this division only. Other divisions are fine. What we need to do, this subsidiary's goodwill needs to be allocated to the CGU, to the divisions, to find out proper carrying value of a division. Maybe little bit higher goodwill will be given over there, 15, maybe 10, maybe 5. Depending on the size of the division, more or less goodwill is allocated. Based on the book value proportion, goodwill is allocated to the CGU. Now this is our target CGU. We are going to impairment test this particular CGU. So we have goodwill, and we need to take net asset. Maybe that is another 15, 25. That's the carrying value for impairment test. Carrying value for impairment test, not to show in the statement of financial position. No. For the impairment test. All right. Once you have got that, next we will talk about some other assets like goodwill. So this subsidiary can have that kind of other assets, the corporate assets. Like subsidiary has 3 divisions and a head office. Head office doesn't generate any cash. The head office just manages 3 divisions. So that head office asset will be called corporate asset. Head office can have a ERP software, but spending lot of money. Yeah, or other type of asset, head office building, you can say. Those assets should be allocated, channeled down to your 3 divisions. Yeah, corporate assets. Then you get a carrying value of your division, compare it with the recoverable amount to check whether your division is impaired or not. You have carrying value including the goodwill and corporate asset, $25 million if recoverable amount from the division. Recoverable amount, you can sell the division for 20, or you can get the benefit of 22 by using the division, running the division. The recoverable amount will be 22, carrying value 25, impairment loss $3 million. That's the way to go, guys. So for cash generating unit, be careful about goodwill or allocated goodwill. Also allocated corporate assets. Cash generating unit. Example, subsidiary, associate, joint venture, branch, division, things of like that. Now, allocation of impairment loss. How do I allocate impairment loss to my assets? All right, come to this. First of all, when your cash generating unit is impaired, let's put the cash generating unit over there. This is my division. Carrying value was $25 million. And recoverable variable 22, loss $3 million. Fine. This $3 million loss needs to be allocated to the individual assets of this cash generating unit. Individual assets of the cash generating unit. Just a minute, let me hide my face. Carrying value $25 million, recoverable amount $22 million, and loss is $3 million. Take the loss and put it in various assets of the company. Land, building, machine, goodwill, etc. 0.5, 0.4 maybe. Put the other thing in wherever it is relevant, 2.1 maybe, like that. You need to allocate it. Now when you allocate impairment loss to the assets, you need to follow a specific sequence. What is that specific sequence? First of all, you need to identify any obviously impaired asset. Means you are sure that this is the problem asset. An aircraft is crashed, obviously impaired. Correct that first. Put some impairment loss in that asset. A train is crashed. All right, then put some impairment loss on that train before proceeding further. Yes. Then you say train is crashed. Yeah, like that. You got the idea. That's the first thing. The asset that is obviously impaired, put obvious impairment on that asset. Then the second principle. If you find any asset for which you are sure that the asset is not impaired, recoverable amount is equal to the carrying value or higher than the carrying value, do not put any loss in that asset. Do not put any loss in that asset. Like maybe land, maybe the fair value of land is higher than the carrying value. Obviously not impaired. Put no impairment loss in land in that case, yes? Take the rest of the asset. We have goodwill, building, machines. Now find a sequence for that. First, goodwill. Right? Without any judgment. Goodwill. Put impairment loss in the goodwill. You do not need to know whether this is impaired or not. Do not make that judgment at all. Put it in the goodwill. And after putting the in the goodwill, if you still have more loss, then put it in other assets that are under the scope of IAS 36 based on the pro rata of their book values. If the asset is big, it will take more loss. If the asset is small, it will take less loss. All right then. So you got that, hopefully. Remember, carrying value of an asset cannot be reduced below its recoverable amount by charging impairment loss. The example of land. Recoverable amount is higher than the carrying value. Carrying value of that land was $10 million, recoverable 20. No impairment loss can be charged in that. Let me put another asset. A building. Carrying value $7 million. Recoverable amount is $6.8 million. So for this building, maximum loss that can be put over there is $0.2 million. You cannot put more than $0.2 million in that particular asset. That is the maximum. That is the minimum. Exactly 0.2. Not more than that, not less than that. When you know that equation, carrying value, you know that, recoverable amount, you know that for an asset. The loss is the difference. Not more, not less. Exactly the same. Yeah, for that asset. For other asset, you do not know, like a subsidiary has thousands of assets and you didn't calculate carrying value and recoverable amount for those thousands of assets. Of course, you are not going to do that. You are a human being, right? You are an accountant, but you have a life. You are not going to do that. So you just put the loss randomly based on book value proportion to other thousands of assets. But this time, you know the figures, carrying value, recoverable amount, exact amount should be allocated to that asset. Hopefully that makes sense. Yes. Here we have a test of your understanding, guys. After that we will take a break. But let's try to put our understanding into this test. A cash generating unit, say a subsidiary, has a building or many buildings, $30 million, plant and equipment 6, a goodwill, current asset, including all the assets. In your real life, you will look for the net assets, including the goodwill. Total is $66 million. Now, there is a recession hit in the country. Following the recession, an impairment review has estimated the recoverable amount is now $50 million. Assume current assets consist of inventory and cash. We know that, but if it is not given, we will assume it. Inventory is valued properly at the lower of cost and NRV. Inventory is outside of the scope of this IAS 36, but impairment is also applied on inventory under IAS 2. Impairment is also applied on receivables, but not cash, under IFRS 9. Remember that. Those can also be subject to impairment, not under IAS 36, but in their IASs. Like inventory should be valued at the lower of cost and NRV. So when you go to the lower value, you are doing the same exercise, impairment exercise. All right. How do we allocate impairment loss? First, impairment loss, amount of loss. That's what we get, 66 minus 50, 16. Now we need to put this 16 loss to these various assets, and we need to bring the carrying value of that subsidiary to $50 million. Yes. Now let's see who are there. Tasnim, I need to put $16 million loss to my assets. Which asset do I pick first?
Goodwill.
Oh, thank you very much. We do not have any obviously impaired asset, known asset with carrying value and recoverable amount both. So we go for goodwill. Thank you. That's the correct answer. Preeti said goodwill. Then my next question, where we do not put any impairment loss. Who can give me this answer? Masuguya? How about you?
Sir.
Yes.
Sir. It's current asset.
Thank you very much. Current asset, 0. We do not put any impairment loss in current asset. Number one, it's outside of the scope of IAS 36, but still there can be impairment, and we need to figure that out, right? When we do this kind of exercise, we put impairment test to current asset under IAS 2 and IFRS 9 like that. Now, current asset this time consists of cash. Recoverable amount is equal to the carrying amount. And inventory, those are already impairment tested under IAS 2, carried at the lower of cost and NRV. So no further impairment loss will be allocated. All right, then we have left with building and plant and equipment. Who can tell me how much should I put in building? We have still 6 to go. Out of 16, 10 is allocated, 6 to go. How much should I put in building and how much should I put in my plant and equipment?
বাকি 6 মিলিয়ন হচ্ছে প্রপোর্শনেটলি অ্যালোকেট করতে হবে বিল্ডিং এবং প্ল্যান্ট এন্ড ইকুইপমেন্টস এর মধ্যে ওদের ক্যারিং ওগুলা ক্যারিং ভ্যালুর উপরে বেস করে আর কি
Thank you very much.
Building এর জন্য 5 million, 1 million plant and equipment.
Thank you. Mubarak said that we are going to allocate rest of the $6 million to building and plant and equipment based on their carrying value proportion, and Asif calculated it and told us that 5 million for building and 1 million for the plant and equipment. How did we calculate that? We take total book value 36 that goes to the denominator, right? And we put like a total loss that is remaining 6 multiplied by the carrying value of the first asset, that is 30. Do the same exercise again. 6 loss to be put out of total 30 plus 6, 36 asset. Carrying value of the second asset is 6. This is how we calculate it. We got our impairment loss. Now we can get our carrying value. Simple. 25, 5, 0 and 20 make a total 50. Yes, that's correct. All right, now we will go for a break. There you go, guys. Welcome back from the break. Yes. Now we are talking about reversal of impairment loss. To understand that, let's go back to previous slide just for a while. There we had a building, right? With $30 million carrying value. We have charged $5 million impairment loss on the building. And the revised carrying value became $25 million. Same as to the recoverable amount if that is available, otherwise just a result of that and carrying value. Just let's call it carrying value. Now once we have charged the impairment loss like 30, 5, 25 last year, this year we need to review whether there is an indication that the impairment is reversed or not, whether the value of the asset is increasing or not. Every single year we need to review whether there is an indication that the impairment loss may have decreased or not, whether the asset increased in value or not. In that case, we need to calculate recoverable amount, and if necessary, we will reverse impairment loss. If recoverable amount is higher than the carrying value, then reverse the impairment loss that was charged in the first place. Let's assume last year the asset has life of 10 years. When we did the impairment test, at that point, not from the very beginning, from the point of impairment loss, the building had a life of 10 years, so we have charged 2.5, not 2.5, yes, 2.5 depreciation, that is depreciation, and the carrying value became 25, 2.5, 22.5 million dollar. That's the new carrying value after 1 year. At that point, if I see that the NRV of this asset or value in use of this asset is $30 million, $25 million, $24 million, higher than the carrying value simply, then I have sufficient evidence to reverse impairment loss. Right. So in order to reverse it, we need to calculate the carrying value that the asset should have had without charging the impairment in the first place. Means if I do not charge impairment $5 million on the asset last year, then what would have been the carrying value of that asset? We would have been calculated depreciation 3 instead of 2.5, and carrying value of that asset would have been today, without considering that impairment loss, $27 million. $27 million. Calculate the carrying value of the asset without charging impairment loss in the first place when you see the asset's value is increasing. Asset's value can be increased to this amount by reversal of impairment loss, 27. So here is the situation after 1 year. Carrying value 22.5. Carrying value without impairment 27. Maybe let's put N or V as recoverable amount. Let's put NRV of this asset 29. So when we reverse the impairment loss, we say by reversal, I cannot take the value of this asset to 29. By reversal, remember, by reversal, I can't take the value of this asset to 29. I can take the value of this asset to $27 million. Try to understand. If I did not charge impairment loss in the last year, then the carrying value of that asset would have been today 27. This is the calculation. Just 30 without charging impairment, depreciation deducted, 27. So I cannot take the value to 29. I can take the value to 27. So reversal over here, reversal will be 27, 22.5, that is $4.5 million. Then carrying value 27. Then if I wish to take it to 29, then I can say there can be another step. I can say let's revalue that asset. If I follow revaluation model, I can revalue the asset. Revaluation surplus. Another 2, then it becomes 29. If I follow revaluation model. All right. Let's put.
Sir,
yes.
Sorry.
Yeah. No. Yes.
It's like you have to take out the impairment charge out of the entire equation, correct?
Right.
So, like 1 year from now, where the value started as a value of 30 million,
right,
then you take off the impairment,
the value becomes 25. That happened in the
20.
last year.
Yeah, but if you rectify your steps, it becomes 27 because you're charging $3 million as in the form of depreciation.
Yes.
You're carrying value to 27.
27.
So আপনার এই steps পর্যন্ত আগে আপনার আসতে হবে, right?
Right.
তারপরে আপনি revaluation করবেন.
Right. So first I would say 22.5 to 27. This portion is reversal of impairment loss. Then if I need to increase further, that can be classified as revaluation surplus. Very good understanding. Now let's put some more illustration over here to clarify this topic. Again, this is last year. 5 is deducted from 30. Then 25 depreciation this year. 2.5 carrying value we got 25. No, sorry, 22.5. Let's read it, 22.5. Yeah. And rectification without impairment, ignoring impairment. 30, there comes 0, and there comes 3, 27. Yeah. Now this time I will put a different NRV, recoverable amount, recoverable. Equals to $26 million. This time the question is, do I take the asset to 27 or 26? To 27 or 26? Anyone give me the answer? Whoever got that?
So 26 হবে.
Thank you very much. That's the correct understanding. 26. The asset's value should not be more than a recoverable amount, and that is the basic objective of IAS 36, that no asset is carried at a value which is higher than the recoverable amount. That's the objective of IAS 36. The very first thing that we have learned. Do not take it over recoverable amount. And one thing you need to notice here, that is, take it to 26, $1 million, sorry, 26, sorry, where is that? 26, nah? Take it to 26. This is my main calculation. So I need to add 3.5. Reversal. Recoverable amount. You need to just calculate that. NRV value in use. That is 26. Reversal of loss 3.5. See this pattern. The reversal of loss may not be equal to the impairment itself. It can be different. It can be lower, and that is okay. Right, a common mistake that students often make, like over here, the previous illustration, go back to there once again. In previous illustration, our impairment loss that we have charged was $5 million. The asset fully recovered and upward revaluation happened. But the reversal amount, calculated reversal amount is 4.5. It's okay because there are some other effects that already happened because of that passing of 1 year. Like depreciation, 2.5 is charged instead of $3 million. So there is this 0.5 adjustment already happened over the year. So it's okay that your reversal of impairment loss is 4.5, where your original impairment loss was $5 million. A common silly mistake students do, that impairment loss was 5, so it is fully recovered, so full $5 million will be reversal of impairment. No. It may not be the case. Remember. So where were we? Here we are. Further increase, we have illustrated that after reversal, if I need to increase the value further, like from 27 to 29, follow revaluation model and put that $2 million in revaluation surplus. Reversal of impairment of goodwill, very important, is not permitted. And there are some other assets. Those are maybe internally generated intangible assets that are not permitted for capitalize. But you have purchased it. It's not internally generated, it's purchased. But if it were internally generated, you didn't have permission to capitalize it. For that kind of asset, it also will fall in the same category of goodwill, like a brand. If you change the name from goodwill to brand, same rule is applied. Impairment loss of brand should not be reversed. Yeah. Now, sometimes present value of future cash flow of that asset may increase simply because of advancing time without changing the real situation. The asset did not improve. No. The effect of discounting simply changed. Value in use changed as a result. Okay. And this cannot be taken as an indication of reversal of loss. Let me give you an example. You are in 2020 to 2020, yep. Or let me start a fresh page, better. 2020 Jan, 2020 June, or 1 July. And income you were expecting in 2025 Jan, say $100 million from your asset. You have a physical asset, say, from where you are expecting an income, just one income. To make this situation simple, we will receive income in 2025. All right then. Carrying value is $98 million. And value in use, that is the recoverable amount. At say 15% asset specific market rate. At 15% we need to discount it. Yes, let's do the discounting. 100 million divided by 1.15. How many years are there? 2020 to 2025, January, that is 5 years to the power 5. It's only 49.7 $49.7 million. Let me put the equation. 100 over 1.15 to the power 5. 49.7 recoverable amount. So the loss 98 minus 49.7, 48.3. That is the impairment loss. Yeah, you did that exercise on 1 Jan. Now you genius have an idea on 1 July 2020. You calculate again the present value, recoverable amount, value in use of that asset using the same cash flow, same discount rate. This time it is like this, 1.15, same cash flow, same rate, to the power 4.5, because 6 months already have been passed. So what do you get? Now you get 53. Previous recoverable amount at the beginning of the year 49.7. Sorry, I just jumped. I lost it. So you got the idea, right? Previous carrying amount was 49, and the current, after 6 months, the carrying amount is becoming 53. 1 Jan, 1 Jan, 1 July. Same amount, same rate, but the present value different. 49.7, 53.3. These are the present values. And now you can say, oh, the value of asset increased, so let's reverse impairment loss. Sorry, this is not acceptable on IAS 36. Right, this is that principle. Sometimes present value of future cash flows from an asset may increase simply because of advancing time, only because of passing 6 months out of the equation, without improving the situation, environmental situation of the asset or cash flow associated with it, or the discount rate associated with it. So such improvement in value cannot justify a reversal of impairment. You can't reverse impairment in this case. Yeah. Hopefully you got that from the illustration. I hope so. All right then. Now we will go to an exercise. He holds a non-current asset which was purchased for $10 million on 1 December 2001 with an expected useful life of 10 years. On 1 December 2003, it was written down to its recoverable amount $4 million. So we got the cost, $10 million, 10 years life, and then it is written down, impairment happened to $4 million at 30 November 2004. The asset was reviewed for impairment and revalued to $16 million. So assets value increased substantially. Now we need to discuss with suitable computation how to account for any potential impairment of the above non-current asset. Let's do it, guys. Should we reverse the impairment or not? The answer is yes, we should reverse the impairment.
এখানে হচ্ছে আপনার ব্যাক ক্যালকুলেশনটা করতে হবে যেখানে আপনার ইলাস্ট্রেশনের পার্টটা কভার করতেছেন,
right? So first we will put the normal situation, current situation, and then we will put side by side a rectified situation. So this is the current flow of calculation. We started with the cost, $10 million. Then we need to find out how many years have gone since 1 December 2001 you purchased it and 1 December 2003. Yeah, that is spread. 2001 to 2003. depreciation for this years. 1 to 2, 2 to 3. 2 years have gone. Yes? So depreciation, accumulated rather, 10 over 10 multiplied by 2 is going to be $2 million. Then we got $8 million. And at that point, impairment was carried out and the asset was written down to $4 million. So let's put that over here. Loss $4 million. And then we got a carrying value of $4 million. Then further time passed. How much further time passed? At 30 November 2004 means another 1 year has gone. So we need to depreciate it for another 1 year. Let's do that now. After impairment, of course, we need to re-estimate the life. Re-estimate. Life, residual value, everything. So we got the life re-estimation. If nothing is told, then we will take, okay, I had 10 years life. So for 2 years is gone. So the life should be now 8 years. So 8 years. So depreciation 4 over 8, that is 0.5. 3.5 is the carrying value. And then recoverable amount or value, new value equals to 16. And we have this problem. What do I need to do first? I need to calculate a rectified thing. Rectification. There everything will be similar, just the impairment will be ignored. This part is similar, all the same. This impairment loss is ignored. So we still have that $8 million. Then this depreciation is going to be like same $1 million. 8 by 8 you put that, or 10 by 10 you put that. It's going to be $1 million depreciation there. So carrying value should have been $7 million. Once we figure that out, then we need to find out a plan. From 3.5, I need to go to 16. How do I do that? Right. Now, I ask your participation on that particular issue. Some of you may participate and tell me the answer. How do you go to 16 from 3.5? Yes. Anyone? Come on.
I need to identify the market value first.
Yes, we got that 16.
আমার যেটা মনে হচ্ছে যে আমরা ইম্পেয়ারমেন্ট রিভার্স করব to 7 million and rest of the amount ওটা রিভ্যালু করা যাবে যদি চাই আর কি, বাট 7 মিলিয়নের উপরে আমরা হচ্ছে করতে পারবো।
Thank you very much. So Rusho gave me the correct answer. Rusho said we need to follow two-step approach. The step 1 is going to be like that. Step 1 from 3.5 to $7 million. That is 3.5. This is reversal of impairment. This will be put in profit or loss, and then it will be carried to the retained earning. And step 2, we got 7, from 7 to $16 million. There we get another $9 million we need to add. And this is called revaluation, if we follow revaluation model at all. Surplus. PLUS. That goes to OCI. Kept in a separate reserve, of course. Well, perfect, Rusha. Thank you very much. You got it. Just awesome. Any question, anyone, on this particular thing? Anyone? Any question? No. Then let's go back. So next we talk about disclosures, guys. Here comes disclosures. The first thing that we're going to disclose is impairment losses recognized and reversed in profit or loss, in other comprehensive income during the period. Last year we have charged $4 million impairment loss, last year's disclosure. This year we have reversed like 3.5 impairment loss in profit or loss. Disclose that. If it is in OCI, disclose it. In OCI we have put this much. Line items of the statement of comprehensive income or a statement of financial performance. Did you put the loss in admin expense, distribution, cost, COGS? Where did you put it, the loss? Okay, it depends on the use of the asset. Like factory machine, maybe impairment loss you will put in COGS because those are used for producing the inventories. Yeah, maybe head office building, maybe impairment loss you will put in admin because it's used for administration purpose. Sales type of thing, distribution, related to distribution. Yeah, you got the idea. Now, by reportable segments, you need to disclose impairment loss, how much you have recognized, and impairment loss, how much you have reversed. Now, for segments, we have another IFRS. We will discuss that later. For now, I'm going to give you a brief idea. This is Unilever. This Unilever has operation in India, has operation in Bangladesh, has operation in many other countries. Operation in a different country is considered as a geographical segment. Very important. So this company needs to report if it is listed. Otherwise, for normal small companies, segment report is not required. Big listed kind of companies, segment reporting is required. Yeah, how much profit loss it made from India, how much profit loss it made from Bangladesh, how much asset it has in USA, how much liability it has in UK. This kind of report it needs to produce. Not only that, how much impairment loss it suffered in USA, how much impairment loss it has suffered in India. That report must be produced. That's disclosure. Huh? That's the disclosure. How much reversed? Same. That's an example of geographical segmentation, but there can be other type of segmentation apart from geographical segmentation, like product segmentation. Think about Samsung, maybe. Samsung. Let's put Samsung there. Samsung. It can have segments like mobile, computers, very big segments, right? Each of the segments are material, and they also produce household equipments, other equipments. Let's put other equip, and they have many other businesses rather than it's not only the technological business. They have many other businesses, financial businesses, and other. Now they also need to, in their financial statement, they need to produce this kind of table: how much revenue they earned from mobile phone, from computers and related things, other type of things like television, refrigerators, washing machine, that can fall in other equipment. Similarly, impairment loss and reversed, that needs to be disclosed over here, based on segments. That's your segment reporting. You got that? Now, material impairment loss, of course, events and circumstances resulting in the impairment loss, like key, we have done that question. Why 4 million impairment loss we have charged in the first place? What was the indication? What was the result of testing, etc.? Amount of loss or reverse for individual assets. For individual assets, we need to disclose nature and the segment to which it relates. Where the building belongs, what kind of building do we have that is impaired? And for cash generating unit, description of the cash generating unit, it's a subsidiary. It's a division that is impaired. Amount of loss, reversal, class of assets and segments, etc. should be disclosed. Hopefully you got a general idea of the disclosures, right? For disclosures, you do not need to memorize the whole list of disclosure. As an accountant, when you prepare annual report, you always like take the list and check whether you have complied those or not. That's gonna be the normal approach for an accountant. Yes, but you have to have general idea so that when you provide consultancy, you can identify the problem. Like if you are a doctor, you need to understand you have to have general sensitivity to understand whether a person has corona or not. Yes? So, the tube light, the bulb should be there. When you get information from the environment, it should click. Oh, they are not providing this kind of disclosure. Maybe it's necessary. Let's discuss it. That sensitivity is required. Good. Go to some practice question. Here we have a question, Scramble 2011. Scramble develops games and it considers the games to have an indefinite useful life, which is reconsidered annually when the intangible assets are tested for impairment. Scramble determines value in use using the estimated future cash flows, which include maintenance expenses. Maintenance expenses. Good, fine. You put maintenance expenses. I got it. Then what? Capital expenses incurred in developing different versions of the game and expected increase in turnover resulting from the above mentioned cash outflows. Scramble does not conduct an analysis or investigation of differences between expected and actual cash flows. Tax effects were also taken into account. So this will be a question for like 5 marks, 6 marks, like that. Right? So for that, you got to identify a couple of points that you need to discuss, on which you need to provide consultancy to get whole 5-6 marks. Now let me identify the point for you for now. This is my first identification of point, and Baki Billah, you tell me whether it is correct. They have included maintenance expense in the future cash flow projection to calculate value in use. Baki Billah, this is one point. Right, so we need to take net cash inflow. Net cash inflow means it is after deducting relevant expenses. What kind of expenses? Operating expenses, maintenance expenses, consumable expenses for the asset should be deducted. Now there is another point, Baki Billah. Annually indefinite useful life, is it good? Impairment test?
Yes, sir. Any
Right.
assets which has indefinite useful life should be considered annually for impairment loss, whether it is
Whether there is indication or not, but
not.
same time. And number 2, multiple impairment tests will be required. Annual
If
impairment
there's
test may not be sufficient. If there is, yeah.
Yes.
If there is, Bakibillah, finish that sentence.
Sorry, sir?
Yes, finish that
If
sentence.
there's any indication that there might be impairment for the
Perfect.
asset.
Perfect. Thank you. Awesome. Now let's go to Hasib. Capital expenses. You get that? Incurred in developing different versions of games and the expected increase in turnover resulting from the above mentioned cash outflows are also taken into consideration when deciding value in use. Is there any bulb lighting up in your brain? Come on. This is your thing, Haseb.
So confused.
Okay, future, let me help you with a little bit hints. Future capital, future planned capital expenditure. In that case, what do you say? You still confused? Then Robin?
If it is future capital expense, I think should not be used.
Right.
The value.
And what about if you have a 2-floor building, right? You are projecting cash flow for 20 years. No, sorry, 5 years, then using some growth rate. 20 years you will use the building, 2 floors. After 2 years, you will add another 3 on top of that 2. That is planned future capital expenditure. And you are also considering the revenue from another 3 floors that you are planning to construct after 2 years. 20 years the building will last. Should you take those rental income from another 3 floors of the building?
No, sir.
Thank you very much. Who said that? No?
Hasib.
Hasib. Perfect. At the current condition, we need to make the assessment based on the current condition. 2 floors cash flow for the next 20 years. That's your consideration for the calculation of value in use for impairment test IAS 36. Very good. Give some explanation and make up a sentence in your own way, and that will be sufficient, inshallah. Next one. Yeah, Hasib.
Sir, anytime for any kind of impairment, we should not take during the calculation of value in use, should not take any future expenditure, either it is revenue or capital.
We should not take future capital expenditure. We should take maintenance expenditure like this. This was absolutely correct. Deduct maintenance expense. Like deduct depreciation, that kind of things. If you consider that as a cash outflow, it's not a cash outflow, right? So cash flow estimation, depreciation should not be taken. But if there is some sort of replacement of parts, replacement of minor parts, not overhaul, in that case that will be capitalized, capital expenditure, that will become repairment. Yeah, those should be deducted. Then the third point. Alright guys, Scramble does not conduct an analysis. Mubarak Hussain, you got this point of investigation.
না, এটা ইনভেস্টিগেশন করতে হবে এবং এটার যদি ভেরিয়েন্স থাকে সেক্ষেত্রে পরবর্তী ইউজফুল লাইফ মানে যেটা প্রজেক্টেড পিরিয়ড আছে ওইটাকে রোলিং বাজেট চেঞ্জ করে নিতে হবে আর কি।
Thank you very much. So Mubarak Hussain said, future cash flows are not factual things. Those are just estimation. Just estimation. Once again, Mubarak Hussain said, future cash flows are just estimations. Those are based on reasonable and supportable assumptions, but assumptions may be incorrect, estimations may be incorrect. So always we need to check the reasonableness of our estimations. Yeah. So when we have actual data, we need to compare between the budget and actual, and variance analysis must be done, and corrective action needs to be taken for the future cash flows as appropriate, and the revised value in use should be calculated at that point. Okay? That is absolutely necessary. Otherwise, we will say scrambles, impairment loss may be understated or overstated, who knows, may not give true and fair view. And finally, after that, Rusho tell me, what about the tax? Tax effects were taken into account. Like after tax cash flows we have taken, Scramble has taken.
Tax effect নেওয়া যাবে না actually.
Thank you very much. So, Rusho said, the cash flow that we take for value in use calculation should be before tax, and the discount rate also should be before tax. So Scramble is wrong on this particular issue. Next question. Scramble has 2 cash generating units. After having indication of impairment loss, it has defined the recoverable value of CGU by calculating value in use. A specific discount rate is not available, and so Scramble used its WACC to discount associated cash flow. Now, first discussion is about this one, just like this. Regarding discount rate. Same question, second part. And again, you will have 5-6 marks, sometimes 7 marks for a part. Maybe it will not have more than 5-6. For a CGU, previously we talked about mainly cash flows, and this time we are talking about mainly discount rate. A specific discount rate is not available, and so Scramble used WACC. Do you complain or do you accept? Do you have any advice to Scramble on it?
So we should use first risk-free rate. If not possible, then we should go for the incremental borrowing rate. If not possible, then we can go for the WACC.
WACC.
Yes.
Well, you missed something here. What did you miss here?
Asset specific market.
Thank you very much. Thank you very much. That's the first priority, market rate. Asset specific market discount rate that reflects the required return of an investor if the investor was to invest in an asset with similar risk, similar timing of cash flow, similar amount of cash flow. This is going to be a market assessment of time value of money. If that is not available, said in this question, then other rates can be used. Yes, WACC can be done, but we have other better rates maybe. Yes, you are right, other better rates can be available. But first, do not miss that market assessment of time value of money. In determining KD, Scramble used reference to a loan, because WACC means it's weighted average of cost of capital. So we have cost of debt, loan interest rate over there. We have cost of equity, dividend rate, etc. Cost of preference share in WACC. Those are built in. So they have considered a loan which was raised 2 years earlier. Now, Tasnim, do you have anything to say on this, Tasnim? Okay, Asif? What do you say?
Historic information, irrelevant. Current loan.
Right. So how do you explain it to your client? Just make an explanation to your client. You will get like 2 marks out of that explanation.
How do I explain it to my client?
Yes.
By saying that historic loan information are no longer relevant. So you have to make your assumptions on rates that are prevailing today.
That's very good.
I get it.
You can say maybe the interest rate has changed significantly over the last 2 years. Who knows? Let's investigate.
Yep.
And
That's
IAS 36 allows us to take incremental borrowing rate, and that is the interest rate of a loan. If you take today, then what will be the interest rate? That kind of thing is allowed. Yes, thank you very much, Tanvir. And that was the issue. Then Ratin, can you find any other issue over there? I'm just highlighting, I'm not saying it loud. Ratin.
Yes, sir.
Yes.
Hello?
Yes, I'm listening. Ratin.
What's the question?
What's the question? I highlighted it for you. They have calculated the value in use using after-tax carry. After-tax carry was the part of WACC calculation, you know. WACC formula, if you know that.
Yeah, weighted average.
Yes. After-tax carry is used over there.
Sorry, sir.
Robin. Let's go back to Robin.
So weighted average কি এটা বলবো না যেটা আন্ডারলাইন করা?
Right. But say whatever you like to say.
আচ্ছা, এটা হচ্ছে আমরা যখন কস্ট অফ ডেট মানে ক্যালকুলেশনে আনি তখন ট্যাক্সটা বাদ দিয়ে আনা হয়, মানে আফটার ট্যাক্সই নেওয়া হয়।
Thank you. It is normally after tax. That is normal companies WACC. And then anything else?
So WACC ক্যালকুলেশন করার সময় আফটার ট্যাক্স কেডি ইউজ করতেছে, এখানে I don't see any problem.
Okay, that's the normal WACC calculation process. We always take after-tax carry in our WACC calculation for all business related decisions like NPV, that kind of things.
It's always KD.
Yeah.
KD.
Yes. Right. After tax. Yes. 1 minus T. But like in IAS 36, anyone can give me the point.
এখানে প্রি-ট্যাক্স কস্ট অফ ক্যাপিটাল নিতে হবে, প্রি-ট্যাক্স ক্যাশ ফ্লো নিতে হবে।
Right. Even if it is not that traditionally correct, if it is not politically accurate, we need to take pre-tax carry because the discount rate and cash flow both needs to be pre-tax. Thank you very much, Mubarak Hussain. That's the understanding. That's the principle of IAS 36. We do not always need to be politically correct in this case. Follow the suggestion. And then finally, Scramble did not provide any disclosure in any annual report. In the annual report, it has assumed the event and circumstances are common knowledge. Asif or anyone else, whoever like to take it.
এটা তো মানে যে ভায়োলেশন করতেছে আর কি, ডিসক্লোজার দিতে চাচ্ছে না, নন কমপ্লায়েন্স।
Okay, so make some, try to convince your partner, or try to convince your, if you're talking your audit partner, audit manager, or client.
So it's a good practice to disclose your this information because investors are interested to know impairment হচ্ছে কিনা.
Right. That helps users of financial reports to understand and compare the financial statements. And IAS 36 specifically requires some of the disclosure. One example will be sufficient, such as amount of
by the way,
impairment should be disclosed. Yeah.
Do we have to like memorize or know the disclosure?
No, regarding disclosure, I said you must have to have general idea regarding disclosure. Other things, of course, you need to know very clearly, like incremental borrowing rate, so that it pops up in your mind, right? Before tax cash flow and rate, though it is not politically correct, but still we need to go for that. That needs to be more accurately memorized. That's it for today. Go home, study, say good night. Allah Hafiz, everyone.
Good night.
Good night.
Good night, sir.
Yeah. Good night.
Good night, sir.
Take care. Bye.